Today, we're deep diving a high-risk contrarian analysis on Reviva Pharmaceuticals, or RVPH.
Yeah, this one's called Everyone is Selling RVPH. Here is why I am watching. It's a speculative case after the stock crashed on FDA news.
Exactly. The FDA wants another phase 3 trial. The stock collapses 45%. So the analysis argues this is a huge overreaction.
But for a contrarian piece like this to work, it really has to tackle the biggest fears head-on.
Which brings us right to our first point. The analysis needs to robustly address the immediate and profound risk of capital dilution, which is really the foundational reason for the sell-off. So the analysis, it correctly points out this ugly truth. The company has about $13 million in cash.
But they need, what, 50 to 60 million more for the new trial?
Exactly. That gap is just screaming dilution at the market. It's why everyone is selling.
And the report's counterargument is basically that the market cap is already tiny, only 37 million. It can't go much lower, right?
Right. That's the tension. But I think there's a weakness here when we look at it through the lens of, say, completeness and focus.
Okay.
The report spots that funding gap, which is great, but it just kind of treats dilution as a high-risk warning sign.
Like a disclaimer at the bottom?
Exactly. It fails to actually model what that dilution does to the valuation. It leaves the whole thesis feeling, incomplete.
I see that. You can't just say the current price is a bargain. You have to show what the price might look like after the inevitable financing happens. That's the part everyone is scared of.
That's a fair point, but, isn't it pretty standard for these kinds of reports to just flag dilution as a risk and move on, let the investor do their own math?
In a normal situation, maybe, but the goal of a contrarian analysis is to fight fear. The market sees that $60 million need on a $37 million company and just shuts down. The math looks impossible.
So the suggestion for improvement is to face that fear directly.
Yes, structure the financing risk as a scenario analysis. Don't just warn about it, build it into the model. Proactively quantify the absolute worst-case dilution to show why even then the current price is still an opportunity.
Okay, I like that. You turn an unknown fear into a manageable, known risk. So let's get concrete. How would you actually do that?
Well, you'd create two clear paths. Let's start with the worst-case dilution model.
Okay, let's walk through the numbers.
You take that $60 million they need, and you assume they have to raise it at the absolute bottom, say the technical floor of 25 cents a share, not even the current 32 cents.
Oof, okay.
60 million divided by 0.25, you're looking at issuing 240 million new shares.
Wow. And they only have about 110 million out there now.
Exactly. You add those together, your new share count is 350 million. It's a massive, massive increase.
You're almost tripling the float. Psychologically, that's a huge weight for investors.
It is, but that's the point. The report needs to do that math, get to that 350 million share count, and then make the argument for why the company, even then, is still cheap, because the drug itself is so promising.
You're setting a new floor, a post-dilution floor. It inoculates the reader against the panic when that financing news actually hits.
Precisely. And then you do the flip side. The report mentions multi-bag potential if they avoid that.
Right, the best-case funding model.
You have to detail what that looks like. Maybe a strategic partnership. A big pharma company comes in with an upfront payment for the development rights. Quantify that. Show how that path avoids dilution entirely and what that means for the stock price. It frames the risk versus rewards so much more clearly.
That makes the whole analysis so much more robust. Okay, so financing is clearly the biggest fundamental storm cloud here.
For sure.
So where does the technical analysis tell us the market is holding its breath? This, I think, brings us to our second critique, focused on structure and flow.
Right.
So right now, the report separates things. You have the fundamental, why I'm watching, the drug works, the valuation is low, and then you have the technical levels to trade, the 25-cent floor, the 59-cent gap fill.
And the trade plan is just based on volume stabilizing around 30 cents.
Exactly. And the weakness here is that it presents the technicals and the fundamentals as two totally separate things. It's missing a critical connection.
What's the connection?
Well, think about it. If that technical floor at 25 cents breaks, it's not just a squiggly line giving way, it's a signal.
A fundamental signal?
Yes. It signals that the fear of dilution has completely overwhelmed any technical support. The contrarian bet is, at that point, basically dead in the water.
I see. So the price level isn't just about buyers and sellers. It's a reflection of the market's belief about that financing risk we just talked about.
And the plan is missing a fundamental trigger to validate the technical move.
Okay, that makes sense. So the suggestion for improvement here is to fuse them together. To make the report more actionable, you have to connect the technical levels to specific fundamental news.
Reframe the whole thing. The 25-cent support level isn't just a level, it's a level that's conditional on what happens with the financing. It becomes a fundamental inflection point.
I really like that reframing. So you're not just passively waiting for a price to hold, you're actually watching for a specific piece of news.
Exactly. Let's give a concrete example. What kind of news are we talking about?
Signaling they've secured, say, debt financing instead of just selling more common stock.
And that AK is crucial because debt, while still risky, avoids that immediate, painful share dilution we calculated. It totally changes the math.
It does. It tells the market, okay, we found a bridge. We're not crushing shareholders tomorrow. And that allows the drug's potential, the real fundamental value, to come back into focus.
And what about the upside target, the 59-cent gap fill?
Well, you can reframe that too. It's not just a random price target. 59 cents could be framed as the equilibrium price.
What do you mean by equilibrium?
It's the price where the market was comfortable before this financing fear hit. So if they get news that solves the funding problem, the stock won't just drift up to 40 cents. It's likely to snap back to that last point of conviction.
So you're connecting the technical pattern, the gap fill, directly to the fundamental story, which is the resolution of that uncertainty.
Yes. It makes the entire trade thesis so much more coherent for someone taking on this kind of risk.
That's a beautiful way to link risk and price. Okay, we've covered how to manage the disaster and the entry, but let's talk about the why. Why even take this bet?
The upside.
The huge potential upside. This takes us to critique 3, quantifying the significance of the addressable market versus the valuation.
Right. So the report does a good job saying the drug, brilaroxazine, has shown strong results. The FDA's request is a delay, not a rejection.
And the valuation is tiny, $37 million. The core argument rests on the drug and the massive schizophrenia market.
It's the right starting points, but I think there's a gap here in, let's call it significance and relevance. The report just kind of says massive addressable market to justify why $37 million is cheap.
It's a bit generic.
It's very generic. It doesn't quantify the incredible mismatch between the drug's actual peak sales potential and that tiny valuation. It needs to scream at you why this is worth the risk now.
I get it. The argument is it's cheap and the market is big. But that's true for a dozen struggling biotechs. We need to elevate it to it's cheap, and here is exactly how big the reward is compared to the risk we just calculated.
Precisely. So the suggestion is to create an aggressive, quantified risk-reward ratio. You have to contrast the estimated peak sales with the current valuation, and you show that the 59-cent target isn't the home run.
It's just getting back to even.
It's just a stabilization point. The true upside is so much bigger.
This is where we really amplify the reward side. So, for a concrete example, the report needs to pull in some real numbers. Industry analysts, what do they say about peak sales for a good schizophrenia drug?
You'll see numbers anywhere from $500 million to $1 billion a year in sales. Let's be conservative, or even just realistic, and focus on that upper end for a drug that works well.
So let's use that, say $1 billion in peak sales potential.
Okay, now you connect that future value directly to today's tiny valuation. If this drug hits the market in, say, 2027 and does $800 million a year in sales, you can apply a really conservative industry multiple, maybe 3 times sales.
3 times $800 million, that's a potential post-marketing valuation of $2.4 billion.
$2.4 billion.
And that's the number. That is the number that puts the current $37 million market cap into just sharp, dramatic perspective.
Yes. By putting that number in the report right next to the $37 million, you demonstrate that the downside, even the worst-case dilution we calculated, is proportional to a reward that is just truly massive. It makes the entire high-risk, high-reward stance of the analysis not just an idea, but a calculation.